There are countless personal finance books, blogs, videos on investing, savings, retirements, and others. But the problem is there is a lot of conflicting information out there, and it becomes very difficult to filter out the basic rules, the fundamental rules among all this noise. So, you can either go through all of this conflicting information yourself, or you can follow Harold Pollack. Harold is a professor at University of Chicago, and in 2013, he wrote down all of this information in a 4x6-inch index card, which later became a part of his book. Pollack's rules are simple and easy to follow. He did not do anything inherently risky or lucky, which actually shows that anybody can achieve financial freedom. But if you read his index card, you will see that it's a bit overcomplicated. So in this video, I'm sharing with you my updated version of his index card. I've put them in the order of importance, and you can start with number 1. And as your financial health improves, you can go ahead with that list. So let's begin. Number 1. Pay off your credit card debt in full every month. You know, the interest rate on the outstanding balance of a credit card is almost 40%. तो अगर आप इसे हर month पूरा pay off नहीं करते हैं, तो it can compound very quickly. To put things in perspective, the average 10-year return from Sensex is around 10 to 12%. So basically, your debt will grow 4x faster than your return. And therefore, you need to make sure that you pay off your credit card debt in full before you make investments anywhere. Number 2, create your emergency fund. Emergency fund is a sum of money that you can use when an emergency strikes. ये रिक्वायरमेंट लिस्ट में इतनी ऊपर है because, for example, if you face an emergency situation like a medical bill or home repair or an extreme situation like you lose your job. Now, in order to pay for these expenses, you will need to take out a personal loan or use your credit card or sell off your investments. All of this will bring you back to square one. But if you have emergency fund, you can come out of these situations without any additional financial burden. If you want to understand how much you should save in your investment fund and where you can keep it, I have a full video on this topic, do check it out. Number 3. Invest 20% of your income. This 20% comes from the 50-30-20 thumb rule, which basically says that 50% of your income should be used for your necessities, 30% can be used for discretionary expenses, and the balance 20% should be invested. If you're just starting in your career, this 20% may be a high number. But as you grow in your career, you should aim for this 20%. Higher in your career, you can even save more than 20%. For most people, this 20% ensures that you have enough money by the time you retire. Number 4. Max out your tax-saving investment options. This is where you should start investing the 20% of your income. These tax-saving options have two benefits. A, obviously, you get to save tax. So if you are in the 10% tax bracket, you can save around 15 to 20,000 rupees per year. And B, these tax-saving options even give you the benefit to choose between debt and equity. If you're just starting in your career, you should choose the investment options which give market-linked return, which will grow your corpus. So for example, ELSS mutual funds or NPS asset class E. And as you get near to your retirement age, you can switch to debt options to preserve your wealth. So for example, PPF or the post office saving account or the NPS asset class C and G. Currently, if you use all your limit of ATC and the new pension scheme, the NPS, you will have 2 lakh tax-free income. And this 2 lakh comes to around 16,666 monthly. If you invest this full amount every year, you will end up with almost 3.5 crore at the time of your retirement. Even if you invest only 10,000 per month, you will end up with almost 2.25 crore at the time of your retirement. Number 5. Invest in the low-cost diversified index funds. After investing in the tax-saving options, you can invest the balance amount in the index funds. So, index funds basically take a bunch of stocks and wrap it as a single investment options. When you buy 1 unit of this index fund, you automatically get diversified in all the stocks inside this fund. This is a very simple strategy that you can follow without paying excess fees or increasing your risk. Now, if you're not investing in index funds, there are two other not so good options. So A, you will either be picking individual stocks, or B, you will be investing in actively managed funds. In both these cases, there is a chance that the invested company does not produce decent returns. Actually, over 90% of the actively managed funds produced lower returns than the index funds. Number 6. Services of a financial advisor. If you are using the services of a financial advisor, they can get paid in two ways. A, they may earn commission on the products that they sell. In such cases, there is a chance that they will sell you the products where they earn the highest commission, even if those products may not be suitable for you. And B, they may work on a fee-based model, where they charge you a flat fees or a percentage of the asset. Now this model is at least better than the first model because these advisors will not sell you the product just because of the commission. And if you follow the 5 rules that we have discussed earlier, you will not need the services of these financial advisors. And last, number 7, give back. If you follow all these advices, you will have a great financial future. And you should help others reach there too. I hope this video gives you a good starting point for your financial journey. You can even tweak some of these rules to better suit your needs and goals. For example, you can save more than 20% and stay ahead of your retirement schedule. So let me know how you are going to modify these rules based on your requirements in the comments below. I hope you find this video useful. Do share it with your friends and family. Click the like button and hit subscribe. Wrapping it up, this is Paritosh signing off.